In July, one trading firm lost about $15 billion. Not a fund, not a startup. Jane Street, which is one of the most feared and most competent risk management operations that has ever existed. It was their first losing month in about a decade. And here's the part that should actually bother you. In the same year, that firm is still up more than $40 billion in net trading revenue, which is more than it made in all of last year. So it lost $15 billion in a month, and it barely moved the annual number. Everybody read that story as Jane Street is in trouble. I think that is exactly backwards. I think the story is what had to be true about the market for a $15 billion month to be survivable, and where that risk actually lies, because it is not in any valuation you have been arguing about. Let me be fair to the artificial intelligence trade first, because I do not want to strawman it. The demand is real. These companies are not selling a story, they are selling capacity that is genuinely sold out. The chips get bought, the data centers get filled, contracts get signed for years at a time, and that is why the whole bubble argument has been fought where it has been fought, which is over valuation. Is 30 times sales too much? Is 40? People have been arguing about that number for 2 years, and it has been, frankly, a boring and unresolvable argument because valuation alone tells you almost nothing about when something breaks. Bubbles do not pop because a ratio got too high. They pop because somebody who borrowed money has to sell something they did not want to sell on a day they did not choose. Which means the question worth asking is not what is it worth. It is who is levered and against what. And this week, for the first time, we got a real answer. It was a hedge fund called Situational Awareness. It was run by Leopold Aschenbrenner, who is 24 years old and used to be a researcher at OpenAI. It was built almost entirely around the artificial intelligence trade, and it was levered. At its peak, it managed about $45 billion. Within a single month, that fell to roughly 10. It got margin called, which means its lenders demanded more collateral, and it had to sell the bulk of its stock portfolio in a fire sale to Citadel, Ken Griffin's firm. And one of the people who had backed that fund was Jane Street. So the $15 billion hole did not come from Jane Street making a bad bet on artificial intelligence. It came from being exposed to somebody else's leverage on artificial intelligence. That distinction is the entire video. Now let me back all the way up, because if none of those words mean anything to you, the rest of this will not land. So, a firm like Jane Street is a market maker. When you press buy on a stock, somebody has to be on the other side of that trade instantly, and it is usually a firm like this. They are not trying to predict where the market goes. They make money on the tiny gap between the buying price and the selling price, millions of times a day. It is a volume business, and it is normally extremely boring and extremely profitable, which is exactly why a losing month there is news. Now, leverage. Leverage just means investing with borrowed money. If you put in $10 and borrow 90, you are controlling $100. If that 100 goes up 10%, you doubled your money. That is why people do it. But if it falls 10%, your $10 is gone entirely, and the lender wants their 90 back. That demand is called a margin call, and here is the cruel part. It does not arrive when you are ready. It arrives on the worst day, when prices are already falling, and it forces you to sell into that fall, which pushes prices down further, which triggers the next margin call somewhere else. That is the mechanism that turns a bad week into a crisis, and it has nothing to do with whether the underlying business was any good. Situational awareness might have been completely right about artificial intelligence and still be destroyed by it. Because on the same day the Jane Street story broke, Broadcom fell about 6%, and it fell on a research note. Bank of America cut its rating on Broadcom's debt and published a stress test on something called XBV. The number that got picked up and shared everywhere was $370 billion, usually described as Broadcom's artificial intelligence debt. Now I have to stop and correct that, because it is wrong as circulated, and I am not going to repeat a viral number just because it is dramatic. $370 billion is not debt Broadcom owes. It is not on their balance sheet. It is Bank of America's modeled maximum exposure in a scenario where this thing scales all the way to 20 gigawatts. Their modeled extreme loss is about $42 billion, so the honest version is less scary than the headline. But the structure underneath, it is far more interesting than the headline, and almost nobody covered that part. Here is what XBV actually is. Broadcom makes custom artificial intelligence chips. Those chips are astronomically expensive, and the companies that want them do not necessarily want to buy them outright and put billions of dollars of hardware on their own balance sheet. So in June, Broadcom set up a vehicle with 2 of the largest private capital firms on Earth, Apollo and Blackstone, plus a group of banks. The first tranche was about $35 billion, covering over a gigawatt of chips, and those chips are leased to Anthropic on a 5-year agreement. So the money to build comes from private credit, the chips get leased rather than sold, and the debt sits inside the vehicle rather than inside Broadcom. Now here is the piece that matters. To get that financed at a reasonable rate, Broadcom provided what is called a residual value guarantee on most of the debt. In plain English, a residual value guarantee is a promise about what something will still be worth later. If you have ever leased a car, you have met one. The lease price assumes the car is worth some amount in 3 years. Somebody has to be on the hook if it turns out to be worth less. In this structure, on most of that debt, that somebody is Broadcom. That is where the actual risk lies, and it is not the size of the number. It is this. When you lease a car, everybody knows roughly what a 3-year-old car is worth, because millions of used cars are sold every year, and there is a deep, liquid, well-understood secondhand market. There's no such market for custom artificial intelligence accelerators. These are narrow, purpose-built chips, and there is currently no mature secondary market for them at all. The residual value in this structure is not observed. It is assumed, which means the guarantee is a promise about a price that nobody has ever actually had to discover. And you only ever find out what that promise was worth in exactly the scenario where you least want to find out, which is the one where demand for these chips has slowed and everybody is trying to establish that price at the same time. This is not a finished thing. The first tranche was about $35 billion for 1 gigawatt. The stated plan is to build the platform out to 20 gigawatts. That is where Bank of America's $370 billion figure comes from. It is not a prediction that it goes wrong. It is an answer to the question, if this works exactly as intended and reaches full scale, how large is the promise sitting behind it? I want to be very precise about why I think that matters, because it would be easy to turn this into a doom story, and it is not one. Broadcom is not in trouble. The lease payments are contracted. Anthropic is a real counterparty with real revenue. Nothing here is fraudulent or hidden or even unusual. Structures exactly like this are how aircraft, shipping, and commercial real estate have been financed for decades. The point is narrower and, I think, more useful. If you are trying to work out how much leverage is attached to the artificial intelligence build-out, and you are reading the balance sheets of the big technology companies to find out, you are looking in the wrong place. It is increasingly not there. It is in vehicles beside them. Which brings me to the tell, and it is the most quietly interesting thing that happened all week. Berkshire Hathaway filed its quarterly disclosure of what it owns, and Berkshire is not a fast money operation. It is the most valuation-disciplined large allocator alive. It has been sitting on an enormous pile of cash, and it had been a net seller of stocks for 13 straight quarters. In the second quarter, that flipped, bought $23.5 billion of equities and sold under $4 billion. First net buying quarter in 14. And the single biggest thing it bought was Alphabet, the parent company of Google. It increased that position by 83% to roughly 106 million shares, worth about $37.8 billion. That makes Alphabet its third largest listed holding now, behind only Apple and American Express. $10 billion of it came through a private placement in June, the rest through ordinary buying. So think about what that actually is. The most conservative buyer in the market just made its largest new commitment in years to artificial intelligence, but look at which expression of it. Alphabet funds its build-out out of its own cash flow, from an advertising business that already prints money. There is no leasing vehicle. There is no residual value guarantee. There is no private credit tranche standing between the company and the hardware. They bought the version of this trade with nothing borrowed attached to it. That is not a coincidence. That is the whole thesis expressed as a position. All right, let me take the other side properly, because there is a real case against everything I have just said. First, off-balance sheet financing is not inherently sinister. It is ordinary. Aircraft leasing works this way and has for 50 years, and the fact that a structure is complicated does not make it fragile. Second, the $370 billion number is a stress test ceiling at full scale. Treating a modeled maximum as a live liability is exactly the kind of sloppiness I just criticized other people for. The modeled extreme loss is $42 billion, and even that is a bad scenario number, not an expected one. Third, Jane Street's loss is arguably a story about one badly run levered fund, not about the system. Situational awareness was concentrated. It was young, and it got caught. Firms blow up in every cycle. Fourth, Berkshire buying Alphabet might simply be Berkshire buying a reasonably priced company with a very good search business, and reading a grand thesis into a regulatory filing is a classic way to fool yourself. Every one of those is legitimate. I would not argue with any of them, but notice what none of them do. None of them change the fact that the two largest artificial intelligence casualties of this month were both leverage events. Neither one appeared on the balance sheet of a single company you have been analyzing. So here is the read I would actually defend, and I will give you the way to prove me wrong on each piece, because a call you cannot lose is not a call. 1. The binding constraint on the artificial intelligence trade is financing structure, not valuation. The next real drawdown gets triggered by a margin call or a funding cost, not by somebody deciding the multiple was too high. I am wrong if the next 10% drawdown in the large artificial intelligence names happens with no forced seller and no credit event attached to it. 2. More of this build-out keeps moving off balance sheets, not back onto them, because that is what makes the numbers work for everybody involved. I am wrong if the major players start funding capacity primarily with straightforward corporate debt on their own books over the next 4 quarters. 3. The unlevered expressions of artificial intelligence hold up better than the levered ones through the next stress event, whenever it comes. I am wrong if the companies funding this through private credit vehicles outperform the ones funding it from operating cash flow through the next real drawdown. And notice all 3 of those describe the same single condition. The demand for artificial intelligence can be completely real, and the trade can still break, because those are two different questions, and only one of them is on the income statement. I will leave you with the question rather than an answer. Everybody has spent 2 years arguing about whether artificial intelligence is a bubble and measuring it with valuation. But this month, the two things that actually broke were a levered fund and a leasing structure. So the question I would sit with is this. If the demand is completely real, and it might be, does that actually protect you when the thing that fails is not the demand but the borrowed money stacked on top of it? Tell me where you land in the comments. And if you want the full walkthrough of everything else that moved today, the consumer rolling over, the 25-year high in government borrowing costs, and the rest of the tape, the daily brief is linked below. This is research and education only, it is not financial advice. I'm Frankie, the asymmetric signal, one contrarian read a day. Subscribe.